Corporate finance practice problem using OneNote. Convertible bond, change in price, and conversion premium. Get ready, it's time to take our chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side, the Practice Problems tab, down in the 1922 Convertible Bond Change in Price and Conversion Premium tab. Also note, when using OneNote, look at the Immersive Reader tool. Our presentations will also be down in the text area with the same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we have our information up top, calculation then on down below. We're looking at those convertible bonds, bonds which have the conversion option to convert into some kinds of stock or some shares of stock if the investors so choose. So the information on the left says we have the convertible bonds with a par value of $1,000, the conversion ratio, meaning how many shares the bonds could be converted into if chosen to do so, 29 shares, the rate at the 7%, the common stock market price, meaning if we were to convert them, the market price of the shares that are currently selling on the market for are at $43. The conversion premium for the bond is $11. That's the conversion premium, the amount over the valuation of the stock. If we were to assume the conversion to take place, value the stock, the difference between the current price and the stock price, the price of the bonds, and the stock price, if converted, is the conversion premium for the bond of 11. And the what if scenario is then going to be the common stock price goes to $31 and the conversion premium goes to $105. So we'll do the comparing and contrasting of this point in time and what could happen or change in the future. So we're going to start off with this top component here, and then we'll take a look at that change in the bottom half. So the conversion value, what would the conversion value be? The conversion ratio is that $29, and we have the commons, should be common stock, market price is $43. In other words, if we took the bonds, we converted them to stocks, we would get then 29 shares of stocks that are valued currently on the market at $43. So that would mean we can value or try to get a value on this type of more complex security of $1,247 if we were to convert them. If we looked at the bond price is going to be the $1,247, and that's going to be what we got with the conversion value plus the conversion premium for the bond, because by definition, the conversion premium on the bond would be the bond price minus the conversion value. So if we're given the conversion premium, then we can get to the bond price by taking the conversion value plus the conversion premium for the bond. Note that you want to kind of understand these formulas two different ways, so you don't want to just think conversion price. I need to remember that formula. You're probably going to be backing into this by thinking of what the conversion premium is generally calculated as. Write that down most likely, then solve for the unknown, backing into then the bond price. The current yield, then, we can calculate as the quoted interest rate at the 7% times the par value of the 1,000, meaning we're going to get paid if we keep the bonds as the bonds and don't convert them. We're going to get the $70 for the interest per year, and we can compare that to the bond price. So 70 compared to the bond price. Let's pull that into the trusty calculator just so we can punch something in the calculator, because the calculator's over there staring at me. So 70 divided by 1258, it gets bored. And so I got to put something in there. So if I move the decimal 2 places over, we're at the 5.56% for the current yield. If we then think about, okay, what would happen if we had this change that took place? The commons stock, shouldn't really have an S there, price goes to $31, and the conversion premium then at the $105. Where would we stand in that case? Well, the conversion value now is going to be the same 29 shares that we can convert these stocks to. And now the commons with an S stock market price is $31. Obviously, we don't have control over the common stock price. It could fluctuate up and down. The ability of us to have the option is one benefit to us if we were the investors. For that fluctuation to take place could be beneficial for us. So we're going to say, in this case, we're going to take the 29. It's now times 31. The market price of the stock means the conversion value has gone down to $8.99. What's the bond price then? Well, we're going to take that $8.99. We're going to add it to the conversion premium, which once again, the definition of the conversion premium is the bond price minus the conversion value here. And so if we're given the conversion premium, then we can back into the bond price. So the conversion premium is now at that 105. So the bond price is now at the 1,004 versus before it was at the 1,258. So what's going to be the effect on basically our new bond current yield after that change has taken place? Well, we'll say that the quoted interest rate is still 7%. The par value is still 1,000. We still have then 1,000 times 7% or interest of $70 per year as long as we haven't converted the bonds. If we compare that to now the bond price, if someone was to buy the bond price at that point in time, buy the bond at that point, then we got the 70 over the 1,004 would give us, let's put that in the trusty calculator again. Calculator's like, that's my job. That's where I come in. Bring me in to the ball game. So 70 divided by 1,004, moving the decimal 2 places over, gives us the 6.97%. 6.97% now versus where we were at before at the 5.56% on the yield. So if we go down and compare the two options or the two scenarios here, where we were at before, we had the price being higher, which resulted in the conversion value being higher because if we were to convert them to stocks, the stock market price was higher than in the second scenario. So we had the higher conversion value resulting in, and then the conversion value compared to the conversion premium on the bond, we had less of a premium on the bond, meaning the bond price wasn't as much higher over the conversion value as in the second scenario here, where now the bond price is a little bit, more above basically simply the value of the bonds. In this case, you have a bit more of a difference there. And then if we take a look, we have the same bonds. So if we don't exercise the bonds would still be giving an annual return of the $70 here. But now we're saying that the bond price before was at that 1,258. So if we purchased it for 1,258 and compared that to the interest rate, we'd have that 5.56 return. Whereas the second one, if we had the $70 compared to the bond price, which is now at the 1,004, then the yield would be the 6.97 increasing to 6.97. So again, it gets quite complex to try to think about what the interplay will be between the conversion option and whatnot, because obviously we're kind of projecting into the future and trying to see, we have that upside if we're the investor of basically taking advantage of the conversion option if it becomes applicable. And then if not, we have the ability to basically take advantage of keeping the bond and getting the return on the bond. So the fluctuations can be somewhat complex because, again, that one little feature can make it a lot more different of a security than other bonds, which are fairly straightforward type of instruments, and other straightforward kind of stocks. So we can, again, try to take different angles to look at these from the stock side of things, from the bond side of things, try to figure out what the value then is of the conversion option.